In one of our recent live events, we had the opportunity to talk with Braden Dennis, CEO and co-founder of Fiscal.ai. I think most of our viewers have seen a few of Fiscal's charts in our videos. We use them every single day, and it was a great conversation that we had with Braden about
Is AI eating software?
a very important question.
Yeah, top of mind, at least as we're filming this right now, we had yet another couple of pretty rough days for enterprise software, enterprise SaaS. And let's break it down because, per usual, the market tends to overreact, both to the upside and to the downside, presenting opportunities for investors. So let's get to it.
And just a quick reminder, you can get access to our live events via a Semiconductor Insider membership, which you can find at chipstockinvestor.com. And while this video is not sponsored by Fiscal.ai, you know very well that we use it every day here, and you can use it too. If you want a discount, you can get 15% off with our unique code, fiscal.ai/CSI. Let's go ahead and get started. Let's see what Braden has to say. Hey, Braden. Welcome.
Thank you.
Thanks for coming on.
We'll just reintroduce you. This is Braden Dennis, co-founder and CEO of Fiscal.ai, which everyone is very familiar with, at least with us using it. We're happy to have you.
Yeah, thanks for having me on. So I like the Naval Ravikant quote, which is paperwork isn't work. Leave it to the robots. And I believe in that. Now, let's go to enterprise software. This is where things get a little bit different, in my opinion. And I am not so bearish on software. As an AI software, data as a service, we kind of check all three of those boxes. Software engineering has changed completely. We are shipping a lot of features to help customers faster now because of AI. Maintaining software is now easier too. The rules of the game have not changed. Just because I can produce software faster doesn't mean I have to really think about what customers want and get distribution and have integration and data modes. There's a lot of moving parts to this, and investors are going, okay, but what about in 5 years from now? What are these tools going to look like? I think that there's a lot of businesses that are in trouble and a lot of them that are selling off for no reason. And I think that that's the whole point of being an investor, is deciphering which ones are opportunity and which ones are traps. I think that there's going to be a ton of money to be made in the year 2026 in some of these companies. A ton. It feels like 2022, where you get something like Cloudflare that sold off 70% and then rebounded 300% 12 months later. Those types of names are going to happen in the next 2 years, where they're getting thrown out for no reason. It's going to be the question of deciphering which ones.
Yeah, absolutely.
Maybe we should address this question that we sent over about what specifically do you see as becoming obsolete when it comes to software, technology? Do you see anything in particular that AI is going to make obsolete in the future? I know you mentioned paperwork, specifically data entry is a big one.
Internally created AI solutions are coming straight for a lot of the busy work that doesn't have a SaaS solution. That doesn't make sense to buy something off the shelf. So my buddy's working on a company that's basically like Claude Code for people who've never written a line of code. AI coding solutions today. If you're not technical, you feel like you're still living in 2021 while everyone's flying cars 2035, right? So you feel kind of out of the loop. So he's building that stuff. And he's like, let's go through some of your software tools that you're buying right now and just see if we can replicate MVPs of them. But I'm like, let's not go after my SaaS tools. Let's go after the 40 things that I hate doing and that my RevOps team hates doing and my sales team hates doing, that there's no off-the-shelf solution for us to go do. It's like, it doesn't make sense for us to go buy some $500 a month solution for, but it's also a huge pain every month, right? So it's going for all that stuff, which is very manual, human-driven, and there's no 1, 2, or 3 player that I can think of that has brand recognition as an existing SaaS tool, because 1, it's such a small market. 2, it's one small process and it's kind of internal to us anyways. So all of those people at my company that do these things, their lives are going to get a lot better. Because I'll give you an example. I was talking with my finance team today, and he's like, at the rate we're going, we're going to need two of me. I can't process this much. And so we're thinking, how can he all of a sudden be the operations of three people with tools we build for him? And so that's kind of the way I'm thinking about the AI of internal investments for me. Those are the things that I really want to automate.
Mhm.
I can think of it like at least a dozen things that we do here that I could use
Yeah.
some assistance, or a Tesla robot for an Optimus.
Yeah.
Yeah, one of those two things.
AI has so many new use cases. It's just expanded really what software is capable of, in my mind.
All of a sudden, you have intelligence on demand from a data center. You have an army of intelligence in a data center that anyone can tap into. And that's extremely powerful for new solutions to be created, but also for existing solutions that we already have to tap into that layer. What we do at our company was not possible before this intelligence in the sky, because I could build it, but I'd be like, okay, venture investors, I need to hire 9,000 people to replicate this data process. And now I have cheap intelligence in the sky. It's creating more information for people and robots to synthesize financial data. Our goal is to give 100 million people high quality financial data. Information gathering has just gotten so much better.
Yeah, absolutely.
We have one question regarding what we just talked about. Would you say that the existing SaaS tools will not be canceled, but their clients will have the bargaining chips to lower pricing, perhaps by a lot?
Yeah, I've thought about this a little bit too around pricing power. The question is leverage coming from customers just going, hey, I guess we'll just build this internally if you don't give us better pricing. That type of negotiation tactic has always existed. There's always been a new startup that'll give them better pricing, but people don't switch for some reason or another. Could this be now a new leverage, a new vector of leverage on replacing? I'm not really sure. Maybe. Software engineering now maybe costs less. So I guess the counter argument to that is that there actually could be significantly more value punched into this with what we're building. Is like we have raised prices in the past, and we create a new tier that costs more. And over the 4 years we've been doing this or whatever, the amount of value that is packed into that tier compared to what it used to have is like night and day. We're not looking at this and going, oh, wow, I can fire half my engineering force. It's going, oh, wow, my 15 engineers are now like 150. Like they're all 10x productivity. And so we're moving features at the door, and people are getting more and more value, and we're growing faster and faster because of it. So that would be my counterpoint if a customer was trying to use that against us. I'd say, look at this, like we shipped 15x value since you started becoming a subscriber.
It's a tough argument to make from a negotiating standpoint, like Broadcom after they acquired VMware. Massive price hikes went into place, completely reshuffled. Everything went subscription based. It comes in a package now, no individual licenses for this product or that. You're just subscribing to VMware if you need it. And a lot of customers, no doubt, looked at Broadcom and were like, you operate at 40% plus free cash flow margins in a bad year. We are not paying your exorbitant price hike. And it ultimately is going to come back to that. VMware, Broadcom is like, best of luck finding the value that we provide somewhere else. See you later, because a bunch of other customers that do realize the value we provide them or are so deeply ingrained in the VMware ecosystem, they're not leaving.
If it's software that can't demonstrate value over time to increase pricing power, then that's not a great place to be anyways.
Right.
Yeah, that's another problem entirely. And there are always going to be companies that are kind of melting ice cubes that are not innovating and eventually go away. Could AI accelerate some of that because people are just expecting more and demanding more out of these melting ice cubes? Then Yeah, absolutely. It could accelerate that eventual kind of churn out of the customer base. Do you think my rationale for this software apocalypse based in reality, or do I sound like a software investor getting crushed in my portfolio and trying to rationalize it? I'm hoping not that, but I always want to be thinking logically here.
Well, we were semiconductor investors in 2018 and then again in 2022. And I wish I had saved some of the comments that I got on at the time Twitter, especially. And then later, when we started the Chipstock Investor YouTube channel, where all hardware was going to get abstracted away into oblivion, and the cloud was literally going to be just something that exists out there in the sky, and there would be no hardware operating software. Some of the CEOs of SaaS companies made it sound like that as well, where I think a lot of analysts forgot that there was infrastructure out there running this stuff. The narrative eventually shifted when a new wave of innovation came that changed the game. And we're in that phase very much right now. We keep saying this for the last few weeks, especially. We are currently at that stage for software where semis were 7, 8 years ago, where all software is just going to become obsolete and unnecessary because the hardware is just so incredible, changing so fast, and the narrative will change because software is a necessary thing. It's the final product, and someone will figure out how to monetize that.
Yeah,
You just have to wait. You just have to be patient.
I'm with you. I remember I learned the hard way as an investor in 23. I was very bullish and still kind of am long-term directionally on a company called BRP. They're the maker of Sea-Doo, the brand, the jet skis, and the maker of Skidoo, which is the de facto number one player in their two recreational sports. The brand share is great. The products are fantastic. And they're the number one market stealer of all these recreational products. So a lot of reasons to like the business. The setup was great, and I made a bunch of money on it really fast. And then I learned the hard way that when cyclicals are cyclical, don't be surprised. There's a reason that they're called cyclical and that people know that they're cyclical. And in my brain, I'm like, nah, rich people are just going to buy these no matter what. And that's true. But on the margins of people who are stretched financially, it does make a difference in the numbers if on the margins things are not working as well. I know it sounds so intuitive, but until you lose a lot of money really fast, it doesn't feel intuitive.
Yeah. And sometimes you have to learn the lesson more than once as well, because NVIDIA literally topped that day in December 2021, and it would not reach a new all-time high for a while. And the questions kept coming in about, should I buy NVIDIA? And I was like, you can buy it, but you have to assume it's going to drop 20% or more at some point. I also believed at that particular point, there was a chip shortage in auto and industrial stocks, especially autos in the aftermath of the pandemic. The conversation started to revolve around, well, these cycles are going to be different from how they were in the past. Maybe it won't be cyclical anymore at all. And so I believe both things were true and got a reminder that cyclical businesses are always cyclical.
It's a good reminder because it's not that they're inherently bad businesses. It's just that you got to remember that the market is what have you done for me lately? That's
Yeah.
how the market operates.
Sometimes with cyclicals, especially, you have to be patient. Timing the market is perfectly fine. Just wait for the cycle.
And buying cyclical at high perceived valuation multiples is usually the best time, which also breaks the frame of a lot of investors naturally.
Yeah. I have one final question. The AI monetization is already happening. You can see it in the hyperscalers. That's where the revenue is showing up right now. At what point, though, do you start seeing companies come to market via an IPO? When do you think that starts happening, in your view, within that world of venture capital, software, and whatnot?
Yeah, there's a great thing about the rise of VC, and there's the bad part about VC in the fact that capital being readily available for early stage companies is better than ever, right? companies that are not ready for IPO but want to do like a B or C round is better than ever. The real problem with venture, in my opinion, right now is there's too much money available in really late stage venture capital. Too late of stage where these companies should be in the public market. They should be available for everyone to participate in the growth of these businesses. It's very important for people my age and everyone in the under 30 crowd participates in assets going up, because the jadedness on the system that we have really stems from not participating in the benefits it provides. So if you see the top asset holders' wealth just go nuclear and you're looking around going like, how do I participate if you don't own assets? You're naturally going to hate the system. And that makes complete sense, by the way. And so how do we get more people to participate in owning assets is important. And then related to your question on how I got here, I don't love the fact that we can fund Databricks' series like Z at this point, right? And not be in the public market for people to participate. It's just bonkers. Why do these $100 billion valuations exist? I hope that more earlier stage, really promising AI companies go public in this next upswing of companies starting to go public, because it's really bad for society if only late stage venture investors are the ones participating in the growth of these companies. That is a fundamentally very bad thing. Only the elites are participating in the growth of that equity value.
Huge problem. And if you continue to treat the public markets as exit capital for VCs, you end up with really weird stuff like securitization structures using blockchains and poly markets and that kind of nonsense to give people weird roundabout access versus just saying, here's the access to it.
If people can't own assets and participate in the system and get the benefits of the system, then that's a real fundamental problem. And if late stage venture is going to reap all the benefits of these next generation AI companies, which is very different from the .com era, all those companies went public. Yes, they crashed and burned in 01, 02, but they were public and people could invest in them and then ride the generational wealth that they created, not just for individual investors who own the individual securities, but the entire broader index, which percolates in pension funds, in index passive investments, people who have advisors who own these funds for them. It's very important. And so the question becomes, what incentive do founders like me who might figure out what's next for the company, what the capital stack might look like, what is the incentive for me to go public if I can get amazing valuations, readily billions of dollars of capital? I don't have to now become public, absorb all those costs. What is the incentive for me to want to become public if that capital is available? So it has created option two that most founders just prefer to have, unless there's some reason where they need to go public. If the board's like, okay, ding, 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 there's no markup for me anymore. We've marked this thing up to 100 billion. There's no investor that's going to mark me up to 200 billion. Let's go public and I'll cash out. If there's no knock on the door, you're just going to keep going, right? Because there's more money to raise and higher markups to find in private markets. You can tell I'm passionate about this subject because I want people to benefit from the system. It's a great system if people own assets. And if you don't, it's terrible.
That rings our bell as well. We are firm believers that the next economic crisis will be created by that structure happening in venture capital. It will probably run further than we imagine it will, like bull markets tend to do. But yeah, it's a problem, and something structural will break to change that thinking and mentality. That's like the argument against a capitalist system is we tend to break things before we change them. But
yeah,
it's a problem and it will get fixed. It'll probably just be a painful, forced fix at some point.
I think so. I don't have any aspirations of going to a Series F private valuation. It's just crazy to me. That being said, all the entrepreneurs are grateful for the abundance of venture capital. People are willing to go far out the risk spectrum and bet on what's next is amazing. But do we need pools of capital for, $100 billion private valuations on the vent? No, probably. I don't think so.
Crazy times.
Curious about your take on Figma and how you value a new company like Figma without a lot of history.
We've waited on Figma an awful lot for the last 7-8 months since the IPO.
Okay. Figma is a fantastic product, wonderful go to market, really smart founders. This is one where I have steered clear of anything when it comes to creative software. Figma is widely used, widely adopted, fantastic product. I'm not a designer, but 95% of the stuff in there you can't do with AI today. And they're integrating AI on top of it, which makes the tool more useful. So the question becomes, what about in 5-10 years? Is that still the case? And that's why I stayed away from these names, because I don't have a degree of confidence in being able to assess that, because I'm not a designer and because I don't know what's going to happen next there. But by all metrics, it looks obviously somewhat attractive here. I thought ServiceNow's quarter was a very interesting narrative versus reality quarter. Their dollar-based net expansion was ticked up in like the highest in 9 quarters or something. And the narrative is that they're completely useless with AI. I'm not in the weeds on design software, so I just stay out of Figma and Adobe, but they look cheap.
Yeah, we own both Figma and ServiceNow. Started buying Figma after the catastrophic performance here as of late. Yeah, the ServiceNow, we had some interesting conversation on this. Interesting things showing up in the financials.
Yeah.
The narrative is completely missing. One of the most interesting ones was the gross margin mysteriously tanking quarter over quarter because of revenue recognition. It probably has something to do with a lot of customers using the AI features, but not getting billed yet.
That sounds about right with AI.
It's consumption based. It's not a subscription anymore. So yeah.
Right. I know from firsthand experience, unfortunately, with a product that people paid for that didn't actually really like, it is happening a lot. And it's happening a lot with even really big companies that have huge budgets to spend on this stuff. So I am not surprised at all about this, because I did it at a small scale and I know what's happening at a bigger scale too.
Yeah, absolutely.
It's a weird market, man. There is some stuff that won't come back. So when everything's getting sold off and being really cheap, be really selective. Some stuff won't come back and it might look the cheapest, and that's because it should be the cheapest.
On
Yes.
sale for a reason.